Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm super excited to be joined today with Bobby Larsen. Bobby, welcome to the podcast.
Thanks, Whitney. Thanks for having me on.
Yes. Well, I know we're here today to talk about Reedville Meadows, 28 units in Beaverton, Oregon. But before we do that, tell us a little bit about yourself, how you got into real estate and where you're at today.
Yeah, just quickly, real estate's been in my blood more or less my entire life. My parents were both brokers. I got my brokerage license fairly early on and worked in sales as well as mortgages throughout college, and ultimately knew I wanted to work in a different avenue in real estate and got into real estate investing straight out of undergraduate and started more on the institutional side and slowly over the last 10 years kind of worked more and more to the boots on the ground method and ultimately started Vanamore in 2017.
Awesome. Well, let's pivot. Let's talk about Reedville Meadows, 28 units, Beaverton, Oregon. When did you close this deal and what did you purchase it for?
So we closed it December 28th, and it's a small deal for us, but it was a phenomenal opportunity. We closed it for $5 million, which is an incredible basis.
Excellent. Okay. So you closed it December 28th, 2023, correct? So
Yes.
just a couple months ago. Let's back up the timeline. When did you first hear about this property and how did you find it? Was it through a dealer, a broker? Was it off market, on market?
So we learned about it through a broker that we're really close with. It was quasi off market. I mean, typically, marketed versus marketed. Depends on if it's direct to seller or not. So it wasn't direct to seller, but it was only out to a couple of different groups that the broker knew really well. Because it was a very unique situation, to say the least. Unfortunately, the seller was an elderly woman who her husband had just passed away, and she quickly was learning the ropes of property management and how it's not so passive. And it was a full-time job for her and one that she didn't want to take on. So she wanted to sell, and we actually worked with her to increase her cash flow from it, because she actually came back and she provided seller financing it as well. So truly taking on a passive role now. It doesn't have to handle the management that we were more than happy to take over.
Awesome. Okay. And what kind of vintage of property was this? And what was your business plan when you took a look at it?
So it was built in 1997. And the siding's all cement board, really strong, great siding. Roofs were just replaced within the last 4 years. The physical aspect of the property from the exterior standpoint was really strong. The interiors, while built in the late 90s, the interiors were dated for sure and they hadn't been touched. So really provided a great opportunity just to focus on those interiors, do a solid interior renovation program and not have to worry about the systems, as you call it, of the exterior going bad.
Okay. So a little bit of value add there. It sounds like mostly and I don't want to say a distressed seller, but a seller that was like, I don't want to have this property. I don't want to be operating it. So tell us how you got it under contract. You said it was quasi off market. Were there other groups that were competing?
Yeah, there's 3 of us from the best that I know actually 2 of them personally. We were all looking at it. We actually weren't the highest price. We found other ways to differentiate ourselves. And there was a requirement to hopefully close by the end of the year. And this was the end of November when we first learned about it. I took a flight the next day to go see the property and walk the vacant units. And we put together a pretty competitive bid that wasn't just based off of pricing, it was based off of the timeline and sure to close. So we had an extension option, but we were targeting and we knew that everyone wanted to target by the end of the year, which was less than a 30-day close at that point. So she thankfully really appreciated that certainty to close and selected us. We ended up going under contract a couple of days later on December 3rd, and 25 days later we were closing. So it was a really quick process. Thankfully, we also have another property that was right down the road. So from a management standpoint, it's also managed together. And we knew the area very well. We had third parties on site doing our due diligence the very next day. And we were able to really get that ball rolling quickly to facilitate, because that's the quickest close I've ever done in my career, was 20 days.
Wow. That's amazing. Okay, so did you put earnest money down? Like as you structured this contract and presented it to the seller, was the earnest money there? And with such a quick closing, was any of it hard?
We put earnest money down. We typically do roughly, 1% of the purchase price initially day one, and then probably another 1% when you're going non-refundable. In this situation, since it was such a quick close, we didn't have any non-refundable the entire time because there was also a lot in the air with the seller financing, the specifics of it, of what that loan agreement would look like. There was multiple ways where her as a seller and the lender could technically blow up a deal if she wanted to because of the language. So we didn't have to put non-refundable money down. We were obviously all working towards the best interests of getting the deal done. And there just frankly wasn't enough time. Typically we go non-refundable after due diligence. And we were basically doing due diligence up until the final days before closing.
Okay, well, let's talk about diligence because normally, people take, upwards to 30 days for due diligence here, and you're doing everything inside 28. So let's talk about due diligence. At what point in time did you walk the property, and was there any surprises?
So we went under contract December 3rd. We were all on site December 4th. It was a madhouse to say the least. Our due diligence, we have all of our vendors out there from roofing contractors, plumbing contractors, electricians, siding, and then we do unit walks as well, like most people do. We do 100% of the unit walks. So every property, every unit that's on site, we go in, we look at the condition of the interiors of the units. We take notes on this unit needs appliances replaced, this stove went bad, this countertop needs to be replaced. We take very itemized, detailed list. And luckily, it was only 28 units. So typically, we have a team of two to three people doing those unit walks. We were able to manage it in a single day.
All right. Okay. So, how did everything go there? It seemed like the bones were pretty good and no real surprises. Was there anything that caused a retrade on this deal?
No, it was as expected. We typically have a pretty healthy budget going into it. And honestly, the unit walks are almost a resident relations tactic because we want to make sure they know, even though the property's changing hands, if they have any maintenance items that perhaps haven't gone answered or still outstanding, we're going to take care of them. And that's basically what, big part of that's for. And that they seem to value that. But no surprises. All as expected within the budget that we put forward.
Hmm. What about the financial due diligence on the property? Any surprises there?
So I'd probably say that falls within the lease audits that we do. So I should have mentioned that too. Part of the due diligence while we're on site. It depends on if they're electronic leases or physical leases on site. Most of the time on these smaller properties that are more, as you say, mom and pop run, they tend to be physical leases on site. So while we're also on site that day, we bring our portable scanners, we're going through all the lease documents, we're making copies of them, verifying that what's on the rent roll in terms of deposits and monthly rent all align with what the leases have. And it was for what it was a very mom and pop run property. The financials were very much in line and they'll track to what the leases said. There's always one or two differences, but nothing meaningful.
Okay. Now, I'm really curious here because, a lot of sellers try to, make sure that due diligence is a little covert, meaning they don't want to exactly advertise that the property is changing hands quite yet until the due diligence is complete. It sounds like, and especially from your strategy, that was not the case, that you guys were very vocal that the property was selling and changing hands. So I'm wondering, like, was that communicated ahead of time with the seller? Were you guys all in agreement that was the strategy?
So even here, it's a little bit of a sensitive topic, and you're 100% correct. It's almost always something that wants to be kept quiet. So here, what we did and what we typically do, we say it's a lender-related inspection, or even it could be an owner-related inspection. They want to make sure that the property and the units are in good condition. So that kind of gives us the disguise to come in without broadcasting that it's for sale, because obviously, like I said, residents get a lot uneasy when they think a property is trading. And then also for the seller's purposes, if a property doesn't trade, they don't want to be in a situation where they have to say, oh, never mind, it didn't sell. And then they have to go back again and do the same thing all over again.
Mm-hmm. And so, when you're having these I think what's unique is, how you guys approach this. And I just wanted to, kind of capture the verbiage as you're talking to the tenant, because I'm sure it's very valuable for you to even get to know the tenants and understand, like, is this somebody that we want to keep, or possibly, like, all things told, like in their lease agreement, is this a resident that needs to move on? Do you guys have a specific approach here?
Yeah, we typically say that we're starting an annual audit process, which we actually do with our properties. Every year, our property management team goes into every unit, whether the owner or the resident is there or not, to look at the physical condition. And that's a big part to us, because that's typically what leads to turnover. And if you can mitigate your turnover just a little bit, it really helps with operations. So we'll go in and say we're completing our annual audits, take a look ourselves. Just ask them, say, is there anything in your unit that isn't working properly, anything that you need fixed? Sometimes they have answers and sometimes they don't. And then you also want to ask a little bit on a personal note, like, hey, what's it like living here? Do you like it? Anything we can do to improve? I think that goes a long way as well, because then it feels like their voice is being heard. They're part of a community and not just a number on the screen.
I like that. I like that. All right. So let's talk about the financing. You were doing a seller financing for this deal. What terms did you land at?
Yeah, so that was a big part of it. And that's what made us comfortable to move quickly, because we knew from our part and our responsibilities, we could close this thing quickly. But part of our terms and our offering was really heavily weighted on the debt. So the seller agreed to a 5% interest rate for 5 years, full term interest only, at roughly 62% leverage. So leverage point was pretty similar with what we would get through agency execution, which we often do. But our interest rate was at the time, 2.5% better. 2% better than what we would get with agencies at that time.
Okay. And then with seller financing, I know this often comes up with, like, public and private debt. Like, you have your interest only period, but is there any sort of term that the seller negotiates in there, as far as, like, prepayment penalty or a lockout period that you can't, refinance the property? I mean, meaning if rates plummet in the next 12 months, I think that there's a lot of operators that are crossing their fingers for this, but that you refinance out sooner. Is that a problem for the seller?
Good question. Here it wasn't. That was a big advantage to us as well. They just wanted in there was a 3-month minimum of what interest is due. Beyond that, there's no prepayment penalty, there's no exit fees. So we looked at it as well. Maybe interest rates do drop, which we don't forecast, but who knows? It's definitely a possibility. And if that's the case, we could refi at higher proceeds and get a much better loan if it's advantageous to us.
All right. Did you raise capital for this deal?
We did. We syndicated this through we still call it friends and family, but we have a pretty broad network of individuals, some friends, a lot of family, and a lot of professionals that are also in the industry as part of our network.
All right. So a lot of operators have challenges closing deals at the end of the year, especially at the pace that you were, right? You wanted to get through due diligence, possibly through, before, talking extensively about the deal with your network. How did you overcome that timeline? And then how did you structure it with your limited partners?
Yeah. Fortunately for us, it was a smaller deal. And that's what made us really comfortable with it. We knew with certainty that this equity would be here, because this was a smaller check size for us. It was roughly $2.2 million of equity coming in. So smaller for us, we were comfortable. We were able to really hold off on raising that capital until we were very comfortable with the physical condition of the property and that we're moving forward. And once we went out, we were actually oversubscribed within 5 days. So it was as expected. We structured it similar to most of our syndications. Sometimes we have 1031s or outside 1031s that are taking place that would require a tenant in common. This one didn't, which also simplified the structure. It's just a single entity, special purpose vehicle that's investing with all of our investors in a single entity.
All right. And what kind of splits did you give the limited partners? Were there any hurdles there?
Yeah. Our standard splits are 80%, 20%. over an 8% preferred return. And then we do have a second tier over a 14% return. It goes to 60/40 for our standard investors. This property wasn't large enough, but we also do accommodate what we categorize as major investors, where those hurdles are increased by 2% on both of those. So it would be a 10% hurdle and a 16% second.
Okay. And then what kind of fees did you charge to this deal?
We just have our acquisition fee. So there's a 2% upfront acquisition fee, but third-party management, obviously that's not a fee coming to us, but it is markets. We actually are able to leverage our portfolio nearby to be very competitive property management fee at 4% for something of this size.
Mm-hmm. And then what about the takeover of the deal? Since you just recently took over, how smooth has the takeover been?
As smooth as they can be. I mean, put bluntly, like takeover is difficult. It's something that should be stressed and people should be aware of. That no matter how much you prepare for them, there's some bumps along the way, but we do everything within our power to ensure that those bumps are just soft little bumps and nothing significant, which has been the case. So takeover has been strong. Day one, like I said, communication with the residents is probably the most important aspect to make sure that they're there and they're being heard. And we have had strong communication with all the residents. We onboard them to the resident portal so that they can email, type, call, or any which way that they have comments or concerns, so they can get a hold of us and just know that we're there for them.
Awesome. All right. So wrapping up, what did you find easy about this deal? Or what did you think was going to be easy that it actually turned out to be harder? And then what did you think was going to be a little bit harder that actually ended up being easier?
Good question. It's not directly answering it, I would say. I would say what I thought would be difficult proved to be difficult was just trying to get third-party reports and third-party groups coming in and organized and processing it as quickly as you need to be processing for those reports during the month of December. December is always a difficult month to get things done. The holidays are rolling around, and certainly December 28th, there's about 25% of the people out there that are still behind their desk working. So that was a challenge. We knew it was going to be a challenge, but we were thankfully able to overcome it.
Awesome. And then was there anything that you thought was going to be a little bit more difficult that actually ended up being easier?
I would say the equity side. I know I said it's a smaller deal, and we thought we were very confident in it, but it had been 18 months since we bought a property last purposely because the market, we weren't comfortable with the market. We didn't really know, we have some really strong relationships. You have contacts that we always reach out to and we're communicating with about their appetite for new investments, but you don't really know until that email goes out, who's responding. And the market has shifted quite a lot since 2022, which was our last acquisition. And I think that the sentiment out there is a little bit more nervous too, which we typically feel like when the sentiment is nervous is the time you want to be buying, but it makes the equity raise more difficult. So we were nervous about going into it. We were still really confident, but like I said, we were oversubscribed in 5 days, so that turned out to be not a worry whatsoever.
Well, Bobby, thank you so much for sharing your knowledge and expertise with us here today. If listeners want to reach out to you and learn more, how can they do so?
Yeah, please do. Reach out to me on our website, vandermoor.com, or on LinkedIn. I'm fairly active on LinkedIn, a little bit on X as well, but still building that one up. But please do reach out. I enjoy these conversations. I enjoy talking to people in the industry or potential investors.
Awesome. Well, again, Bobby, thank you for your time with us here today. We look forward to hearing about your future deals.
Thank you. It was a pleasure being here.